When you look for high income or high yielding stocks, you run into a lot of garbage stocks that are almost guaranteed to lose you money long term. So I'm not only going to show you 5 high income stocks, I'm going to show you 5 quality high income stocks that are actually great companies. 3 out of the 5 different stocks I'm about to show you also beat the S&P 500 over the same time period. Stick around until the end because I will show you how you can generate $100 per month in dividends with these 5 different stocks with an investment of just under 20k. I will order the 5 high income dividend stocks by yield, starting with the lowest yield, although that should never be the sole focus. Number 5 on this list is Store Capital. With a yield of 4.4% at the time of recording, Store Capital has the lowest yield on this list. Based on business quality, I would rank Store higher though. Store Capital has had massive revenue growth since existence, from 40 million to now almost 0.7 billion. Their payout ratio is at 77%, which is perfectly fine for a REIT. This also resulted in an annual return of almost 11% including dividends, about 1% behind the S&P 500 over the same period. Store Capital is a relatively new real estate investment trust that focuses on single tenant profit centers. So locations that are by itself profitable locations for the tenant. This gives Store Capital leverage. Store Capital also deliberately focuses on non-investment grade tenants but instead creates investment grade contracts with those tenants and picks out locations that can give them income statements from that specific location. Christopher Volk is the CEO of Store Capital and he is a well-known and experienced REIT investor. One thing to keep in mind is their dividend safety score of 50, which is borderline safe. This is mainly due to having some exposure to the hard-hit industries. If you want to know more about Store Capital, be sure to check out episode 43, now suggested, in which I do a full analysis on Store Capital. Full disclosure, I do own shares of Store Capital. Number 4 on this list is also a stock I've mentioned a few times already, and that is biopharma company ABBVIE. ABBVIE has a dividend yield of 5% and its latest dividend raise in October was 10%. So ABBVIE has the perfect dividend profile. The payout ratio is at a very healthy 42%. So from that perspective, the dividends are definitely safe. ABBVIE was the spun-off from Abbott Laboratories in 2013 as a research-based biopharma company. In 2013, they started out as a $18 billion company. Right now, they are a $183 billion mega-cap company. In comparison, Abbott Labs, the former parent company, is only a bit bigger at $213 billion market cap. ABBVIE also had a very nice annual return of 17.3% since inception, compared to the 14.3% return of the S&P 500 over the same time period. ABBVIE doesn't score so well on the debt front, as they acquired a lot of debt from the acquisition of Allergan. This was deemed to be a much needed acquisition for ABBVIE to diversify its revenue streams. I've mentioned it before, but that is also what is personally holding me back from investing in this stock. The biggest risk facing ABBVIE is that their flagship drug, Humira, will lose its exclusivity rights in the US in 2023, which accounted for 55% of their sales in 2019, which also results in a dividend safety score of just 50, borderline safe. The third high income company is also a company I've covered before on this channel, and that is National Health Investors, ticker NHI. NHI has a yield of 6% and had an annual return of 15% in the last 20 years, more than double the 6.2% of the S&P 500. The 1-year price performance is even more impressive at 95%, helped by the overall market bull run. The payout ratio is at about 80%, which again is fine for a REIT. National Health Investors, NHI, is a real estate investment trust, specializing in sales and leaseback, joint venture, mortgage and debt equity financing of need-driven and discretionary senior housing and medical investments. They own 200 different types of healthcare properties in the senior housing industry. Their 4 largest operators are Bickford, National Healthcare Corporation, Holiday and Senior Living Communities, accounting for over half of their revenue. Their revenue grew very fast from 83 million to 300 plus million in 2020. The dividend growth is a bit so-so, around 3 to 5% per year in most recent years, but for a REIT that is perfectly normal. One thing to keep in mind is that their dividend safety score is 50 out of 100, meaning borderline safe. This has to do with the current pandemic and some operators that were already struggling before the pandemic. NHI expects that occupancy rates will start to increase now that most of the residents are vaccinated. The company with the second highest yield on this list yields 7.2%. But first, a bit about this channel. I'm Tom from the Dividend Attitude Show. On this channel I make in-depth videos about dividend stocks, battles between 2 dividend stocks and portfolio updates on my personal portfolio. The dividend stock in second place is Ambridge, which was also part of episode 54, 5 undervalued dividend stocks, which is now suggested. Like I said, Ambridge has a yield of 7.2% at the time of recording. If you were fortunate enough to have invested in Ambridge in March of 2020, you would already be looking at the yield on cost of almost 11%. That is crazy. Ambridge operates as an energy infrastructure company, which means they take care of transporting and storing different energy sources, such as natural gas, crude oil, and renewable energy. Ambridge transports about 25% of all crude oil produced in North America. There's a lot to love about this company: its predictable income stream, their wide moat, and generous dividend increases. Looking at the price appreciation in the last 10 years and the payout ratio here on Seeking Alpha, it would be very easy to pass up on this company though. But in this case, you have to look beyond those numbers. For pipeline companies, it is not prudent to look at the earnings payout ratio or free cash flow payout ratio, but rather at the distributable cash flow or DCF payout ratio, and that ratio is around 70%. As a dividend growth investor, Ambridge looks very tempting with the yield of 7.2%, and they have actually just raised the dividend with 3%. The increases before that were a lot more juicy with 10% increases in the last 4 years. It would be a mistake to blindly chase the yield. The question is, why is that yield so high? One of the most obvious reasons is the drive towards reducing carbon emissions worldwide. With over half of the company's revenue coming from crude oil transportation and storage, this is a risk to consider. The other short-term risk is the struggles they have with their Line 3 project. But it seems most of those issues are resolved when I look at the latest quarterly presentation. The dividend safety score of Ambridge is 57, borderline safe. Number 1 on this list yields almost 8%, and that is Arbor Realty. They grew revenue tenfold from 43 million to 430 million in 2020. They have a 5-year dividend growth rate of 16% and the share price increased 271% in the last year. Arbor Realty is an internally managed mortgage REIT, which means they provide financing for real estate. But Arbor Realty is not your average mortgage REIT, because they offer customized financing and faster transaction execution. 80% of their investments in their structured portfolio, 35% of revenues, are in multifamily homes. The rest is in more cyclical real estate such as land and hotels. The other 65% of their revenue is generated from their agency business. This segment earns fees by originating, selling and servicing multifamily mortgage loans, which are mostly guaranteed by government-sponsored organizations such as Fannie Mae and Freddie Mac. The moat of Arbor Realty is that they are able to provide a one-stop shop for smaller loans in the 1 to 8 million range. And because they are a one-stop shop, they can offer fast execution and certainty to multifamily borrowers. The earnings payout ratio of Arbor is around 80%, which is fine for a mortgage REIT. Arbor itself uses debt equity to market cap as a relevant leverage ratio for their business. That ratio stands at 2.3 times compared to the 3 times of their peers. So that looks good as well. Before you invest in a mortgage REIT like this, I strongly suggest you to read up on the inner workings of a mortgage REIT and how Arbor Realty conducts its business. For that, I can highly recommend the articles of Brad Thomas on Seeking Alpha and analysis on Simply Safe Dividends. I'll put links in the description. I have no affiliation with either. But you also need to have a good risk tolerance for this stock, because it dropped 75+% in March of 2020, when the pandemic fears hit its maximum impact. The dividend safety score also stands at 50, borderline safe. Now, you might have come to this video for the monthly dividends and realized, wait a minute, these stocks don't pay monthly dividends. Correct. Clickbait? Maybe a little bit, but hear me out before you click off. These 5 stocks give you the same end result, because payout frequency should be irrelevant. If you invest in these 5 companies, you would receive dividends every month. In fact, you would receive an average of $100 per month with an investment under 20k. Isn't that great? Do remember that with higher yield usually comes increased risk, which I also highlighted with each of these 5 stocks. If you enjoy getting different stock ideas and analysis, be sure to also check out the Dividend Stock Battles playlist by clicking in the bottom right. More deep dive analysis can be found by clicking on the playlist in the top right. YouTube thinks you will like this video next. I'm off. Until next time, bye bye.